Stocks in the green with the major averages and 7 of the 11 S&P sectors hitting new highs. Our next guest is charting a course for potentially more market upside ahead. Joining us now is John Kolovos, Chief Technical Market Strategist at Macro Risk Advisors. John, it's good to see you. I know you've been in the mode of saying, look, you have to give this market credit. It is shown, especially on the S&P 500 large caps, that it actually has this pretty solid uptrend in place. Where did the recent gains take us, and I guess how would you play it from here?
Yeah. Hey, Mike, thanks for having me on. Yeah, there's really little to complain when you look at the S&P 500 itself. Solid series of higher highs and higher lows, moving averages in the right configuration, all of that. I'm looking somewhere north of 5,300 on this leg, maybe even, dare I even say, with the 50 handle of 5,350. And with major support, I would say at 5105. So as long as we stay above that support level, I would assume that pressure is higher. And between now and the next time we talk, I would say that, hey, that 20-day moving average is also a good proxy for the short-term trend. If you were to take that back into the November low, it's hugged, the indices hugged that quite nicely. It's a good trailing stop. So I think 5,300-ish, if not a little bit more on this leg.
Yeah, so that's, it's only a couple, 3% up from here, right? So it's not exactly like you're saying it's game, but even though it was kind of hard to imagine, 6 months ago that we'd be talking about those levels, what is potentially going to get in the way, either in the way of leadership, if this sort of momentum, kind of fatigue in some of the market might take hold, or seasonals, or the fact that sentiment might get somewhat elevated?
Yeah, I think it's all of the above, to be quite frank. I think a lot of us, including me, thought the market would stall out maybe a little bit lower, but keeps proving us otherwise. Seasonals are an issue. The election's going to be an issue. I would say, if I had to guess which one, and I was talking to clients about this earlier today, it's kind of hard to pinpoint which one it is besides the unknown. It could be hawkish macro trends. The interest rate, the 10-year yield has been pushing higher all this year. It's still in an uptrend from that perspective, trying to roll over, really hasn't. The dollar's been sticky strong. So I think hawkish trends that translate into stickier inflation could be something that could stall the market out.
And I know that technology, you kind of downgraded it in your work to more of a neutral type position. What are the favored sectors, and what happened with tech that it seemed to have taken a back seat?
Yeah, don't get me wrong. It's an equal weight, right? So
yeah,
I haven't punted all the way. Yeah, I haven't punted all the way down to underweight at this point. It's quite interesting because there is rotation going on, and it's basically the downgrade of technology has made room for other sectors to move up, like energy and materials, because of the commodity rally, and those are really compelling. But within technology, what still looks okay, semi-equipment is still strong. The hardware names, the system software names. Basically, what's happened is that the smaller cap, less profitable ones have come down. Think ARC names. Those have come down. My universe, by the way, is the Russell 3000, right? So you got a lot of those names in there. They've come in. But also just semiconductors, that industry group, outside of a couple mega ones, real ones that we talk about all the time, there's been some splintering in that area. So that's what's kind of brought down the ranking there, but it has made room for energy and materials to push up.
And then financials, I know they've also improved, and you actually have to make a distinction between financials entirely and then banks, because really a lot of the financial sector is non-bank.
That's correct. Yeah. I guess one thing we can look for to be optimistic, let's make a scenario where we might want to buy regional banks. Interest rates, right? Interest rates need to kind of just stop doing what they're doing, because there is this relationship between market breadth and interest rates. And a big component of market breadth would be these smaller cap banks. So you're right, Mike. I agree with you. Insurance names look good. Capital markets look great. It's just not those regionals, but I'm just trying to think, what would be the next area that could potentially improve within financials? It would be those regionals, and it would have to be tied to the direction of interest rates.